Thanks especially to people who are watching the live stream of this event, and thanks to everyone who will watch the event at their convenience at some point in the future. I am Michael Strain, Director of Economic Policy Studies here at the American Enterprise Institute, and it's a pleasure to welcome all of you here today, and a pleasure to welcome Assistant Secretary Harris, of course, as well. The Russian price cap on oil exports was designed to solve two problems. One problem was avoiding doing anything that would finance Russia's war machine. The second problem was restricting revenues into Russia without driving up the price of oil on global markets, which could, among other adverse consequences, weaken support for Western engagement in the war. This is one of the most important tools the United States has used to counter Russia's aggression and Russia's brutal invasion of Ukraine. And I'm very happy that you are all here to discuss this. I'm happy that you're all tuning in to the video, and of course happy that Dr. Harris is here. Let me briefly describe the run of show. It'll be quite straightforward. Dr. Harris will give remarks following this introduction, and then he and I will engage in a conversation about this topic. And of course, we will take questions from you as well. You can submit those questions to my colleague, John Toohey. His email address is john.toohey@aei.org. You can find the spelling of that email address on the webpage for this event. You're also welcome to submit questions on Twitter using the hashtag AskAEIEcon. That's hashtag AskAEIEcon. Let me introduce Dr. Harris. Ben Harris is the Assistant Secretary for Economic Policy and Chief Economist at the U.S. Department of the Treasury. Prior to joining the Treasury Department, Dr. Harris was the Executive Director of the Kellogg Public-Private Initiative and a Research Associate Professor at Northwestern University's Kellogg School of Management. He also served as the Chief Economist to the evidence-based policy organization Results for America. Earlier in his career, he served as the Chief Economist and Economic Advisor to then Vice President Joe Biden. He was the Policy Director of the Hamilton Project, a Fellow in Economic Studies at the Brookings Institution, and Deputy Director of the Retirement Security Project. He holds a PhD in economics from George Washington University. In 2000, he was awarded a Fulbright scholarship to Namibia. Ben, thank you for being here. We'll now hear your remarks.
Thank you. And let me just say from the outset, thank you so much for hosting me. You've been such a gracious host over the years, and this is no different. So I'm just going to talk casually about our view on the price cap, our assessment for how it's going. I'm not going to read from the remarks because, well, I don't love listening to people read written remarks, and so I'm going to turn this sort of casual overview, and then we can turn this into a Q&A and happy to answer questions. I think from the outset, it's important to understand our motivation for putting in place the price cap from the outset. And so, going back to last year in February when Russia invaded Ukraine, they roiled energy markets and then proceeded to benefit from the chaos that country had created. So we saw spikes in the price of energy. There was a lot of uncertainty around forecasts. We didn't know if Russia would weaponize the trade of crude and refined product the way that they had weaponized the trade of gas. We didn't know whether or not there would be disruptions in supply chains related to energy as a result of the war. So there was a lot of uncertainty, and naturally energy markets responded to that uncertainty by boosting the price of oil and refined product, which of course benefited Russia immensely. They have marginal tax rates on the oil trade of around 70%. So, as prices spike and they have these windfall gains, that just provided Russia with enormous additional revenue that it would use to fight the war in Ukraine. So this was a wholly unacceptable situation. driving up energy prices, using the windfall profits to fight this illegal war. It was unacceptable from our view, and I obviously don't speak for the Europeans, but I think it's fair to say it was unacceptable from their view as well. Then in June of last year, Europeans put in place a 6 sanctions package which had 2 very important aspects. The first was an embargo on the trade of seaborne Russian oil. The embargo was important, but it wasn't critical. The critical part was a ban on the use of services in the trade of Russian oil. So the embargo would say, look, we're not going to take your seaborne oil anymore. You're going to have to divert it somewhere else. But because global oil markets are truly global, you could just have, instead of Russian oil going to ports in Europe, it could be diverted to India or China or wherever else. The really important part was banning Western services like insurance coming out of the UK or Greek shippers or perhaps financing coming out of Europe that said, look, it doesn't matter if you're shipping to India anymore, you can't use a Greek tanker to do it. And this was concerning from our view because it could potentially drive up the price of oil, and it could potentially drive up the price of oil so high that it mitigated or ameliorated the intention, which was to cut off revenue. So if Russia had shut in substantial amounts of oil and you saw a boost in the price of energy, there's a potential that the ultimate change in revenue could have been so large that the very good intentions of the 6 sanctions package actually fell by the wayside. And you're left not with lower revenue, but rather with higher global energy prices. And so this was certainly a noble effort. We understood what they were trying to do. They were trying to cut back on revenue and to hobble Russia's economy, which was certainly something that we agreed with. But we were worried about global energy prices, and we were worried about the ultimate impact on revenue not being as great as the Europeans had intended. So we worked together, not just with Europe, but with the G7 and Australia to create this price cap coalition. And we formed 2 goals, as Dr. Strain said. We had 2 goals. One was to keep energy markets stable, and the second was to reduce Russian revenue. And the only way to do that, conditional on the 6 sanctions package, the embargo, but also the ban on Western services and the trade of Russian oil, was to say, look, we're going to add 1 extra condition to the ban on Western services. And that condition is you can actually now use Western services to trade Russian oil, but only if you do it if the oil and refined product is traded beneath a price cap. So that is to say, if the 6 sanctions package went into effect with no price cap, you couldn't have any trade from a port in Russia to an Indian refinery using Western services. With a price cap, you can have that trade, but only if it's below a certain price. Now, I think it's important to say that under this price cap plus the 6 sanctions package, you can still have, this is important, you can still have trade from Russia to China or India or Africa, but it has to use non-Western services, and it can trade at any price. So if you're using a Chinese ship using Chinese insurance going to a Chinese port, go crazy, you can rely on the market price. But if you're using a Greek ship or you're using UK insurance, it has to be beneath a certain price. So we landed on, eventually over time, we worked with our allies in the G7, and we came up with a framework where we said we're not going to have just 1 price cap because there are lots of different products, and we're not going to have 2 dozen because that's too cumbersome. And we ultimately landed on 3 different price caps, 1 for crude, another for what we call high-value refined product, which is essentially diesel and jet fuel and some other stuff, and then a low-value refined product for refined products that typically trade beneath the price of crude. So now you have 3 different price caps, but they're all specific to a particular product. We announced this in the fall. We were called lots of nice things on Twitter by experts who said, you don't understand how commodity markets work. You can't just cap the price of a commodity. There'll be workarounds. And we explained, no, we actually do understand how commodity markets work. This isn't a global price cap on a commodity. This is a conditional tweak to the sixth sanctions package. And we actually think that we have enough influence over Western services that this will matter. And we certainly expect subversion. And we choose the term subversion carefully. This is not evasion. Again, if you're a Chinese shipper using Chinese insurance and Chinese financing, going to a Chinese port, that's not evasion, that's just subversion. There's nothing illegal about that. That doesn't violate the terms of the sixth sanctions package and the price cap. And so there was a lot of questioning as far as how this would work. And so banks came out with estimates that said you're going to drive the price of crude not from $80 where we were at the time, depending on the week we're talking about, but up to 135, 150, 185. One bank had around $400 a barrel, which is crazy. And so, what we were trying to do was prevent those type of price spikes that would be associated with the shut-in of Russian production. We were trying to keep the barrels constant, but at the same time driving down revenue. So here we are, mid-March, looking back, and you can say, well, were you successful? How have you been successful? And the first thing we'll say is, look, I want to come with a lot of humility. This has only been in place for really a few weeks. February 5th is when we put in the price caps on refined product. We're not looking for a parade. Things can change over time. Energy markets are fickle. That all being said, we can look back at least to December 5th when we put the price cap on crude and say, look, we had the two goals, which Dr. Strain laid out perfectly. A, are energy markets relatively stable? Yes. I mean, in a period of sort of extreme geopolitical uncertainty, largely related to this illegal war, crude prices have been remarkably stable over the past several months. I mean, they've been trading within a band of about $7 or $8 per barrel, which is, fairly stable. The same is true for refined product. So we've also seen Russian volumes stay relatively stable. They're about where they were relative to pre-war. Russia didn't have the leverage to shut in and weaponize crude and refined product the way they did with natural gas. Happy to talk about reasons why later. The second thing you could say is, okay, fine, barrels are flowing. That's fine. But are you driving down Russian revenue? And the answer is decidedly yes. If you look at the Russian ministry's own estimates, they note that we've been very successful at driving down their revenue. They have called into question their future fiscal stance, saying that this has jeopardized their budget position. Russia has gone from surplus after surplus after surplus to very quickly to a budget deficit. That's not all price cap. That's not all revenues. They're also spending more fighting this war. But part of it is revenues. And we're looking at the data in the markets, and we're seeing really broad spreads between what Russia is selling and what you're seeing for the price of Brent. So heading into the six sanctions package and the price cap, and so pre-invasion, these were basically the same product. There was about $1 difference between the price of Brent and the price of Urals coming out of Russia. Now you're seeing a spread of about $30. What we have done is we've bifurcated the market. We've taken a commodity and we've split it in half. Now people care where the oil is coming from, whereas before they didn't. And so the bifurcation of the market has allowed us to maintain this really broad spread, which ultimately drives down revenues. So I think we have been successful initially. There is some misinformation around measuring various prices, and we can get into that. But sitting here in mid-March, looking at this really broad spread of about $25 to $30 a barrel, a spread that a year ago you would have thought was completely implausible. And we're seeing Russia being forced into month after month of budget deficits. We are fairly optimistic about how this has been implemented. So let me just sort of stop there and turn it over to Mike again for questions or take questions from the audience, and happy to turn this into a conversation.
Thank you. So I agree that it's been very successful. I'd forgotten about all the fun Twitter commentary when it was announced. So thank you for reminding me of that. Tell me if I have the basic idea right. You want Russia to continue supplying oil in order to make sure that the supply on the global market isn't substantially restricted and prices go way up. But you want to push the price they can receive to as close to the marginal cost of production as possible. How do you implement that? You implement that by only offering insurance to ships that are shipping to customers that pay at that price. Somebody might say, because you have to insure these ships, otherwise, no one will drive them. Some might say, well, what if India doesn't comply? What if China doesn't comply? What if this? What if that? Of course, there's going to be non-compliance, but the price cap among compliers and the existence of the price cap should push the global price down relative to what it would have been, even if there is non-compliance. And so arguing that India or China might skirt the price cap is not an argument against the effectiveness of the price cap. It's just an argument about the extent to which it will be effective, but it can still be effective. Do I have that basically right?
You have that exactly right. And so prior to putting the price cap, about 90% of Russia oil was shipped using UK insurance. So there was almost a stranglehold on the shipment of Russia, and that's just insurance, that's just one part of the shipment, but that was highly concentrated in UK insurance. So if you want to ship Russian oil, you need to rely on Western services. Now that share has gone down substantially. Now, by our best estimates, and I will say this has turned into a really opaque market, it's tough to get the data we would want, but our best estimates, and this is public, are that about a quarter of Russian trade is being done using Western services of some sort, and 3/4 are being done using non-Western services. So for those quarter of Western services, those are bound by the price cap. You have to trade under the level that we have set. And that level is $60 for crude, $100 for high-value refined product, and $45 for low-value refined product. But you're right to point to the other 75% and saying, well, okay, well, why is there this big spread? Why does China get to pay so much less for oil coming out of the Russian grounds than they do out of Saudi Arabia? And the answer is we've bifurcated this market and provided China and India and now increasingly markets in Africa and to a lesser extent in Latin America with greater leverage. Because these are different markets. Russian oil is different than Saudi oil. And this has been a boon for oil importers, for crude importers. We get that question a lot. We get that question saying, look, aren't you just transferring the rents from the windfall from Russia to China or India? And the answer is yes. Anyone buying cheap Russian oil is now benefiting from the windfall. We are fine with it as long as it's not Russia. And the rents are distributed around the globe, but we're taking them from Russia and just putting them in other countries, and that's the point.
And just to put some numbers on it, and tell me if I have these right, prior to the invasion, Russia was exporting around 3.5, 4 million barrels per day. That's roughly where we are currently. But revenues, Russia was taking in around $10 billion per month in revenue when the invasion began a year ago. And now we're about half that.
Yeah. And so if you look at January 2023 relative to March 2022, their revenues are down by about 60%. And they've actually institutionalized the discount, and we're quite proud of this. So prior to about a month ago, the way that Russian revenues were taxed were barrels times price times tax rate. Barrels are what they are. The price they were using was the Urals price as reported by Argus, which is this very reputable company that engages in price discovery. And then the tax rate was about 0.7 on average. So incredibly high marginal tax rate. This ended up not working out for Russia anymore because the Urals price fell so low. So now what they have done is rather than using the Argus reported Urals price, they're using the Brent price, which is not the price of Russian oil, it's the global price of oil with a $25 to $30 discount. So we've actually institutionalized in the Russian tax code the fact that this is now a bifurcated market and there are these really broad spreads. Written into their tax code, they're assuming that Russian oil will trade for $30 less than Brent. And we've institutionalized this. It's just truly remarkable over the course of a few months this has now become the standard that Russian oil is not the same as other oil.
So, so short-term success, I think that there's good evidence of short-term success. We see big reductions in Russia's oil revenue. We see stability in the global market. There were credible concerns that over the winter the price of oil could spike well above $100 a barrel. That didn't happen. That didn't happen for a variety of reasons. One of those reasons is likely the price cap. So I think in the short term, we can say that this was a reasonably successful policy, and we have good evidence to support that assessment. Move forward. It's 2023. Let's say it's 2028. Let's say it's 2030. What does success look like along that time horizon?
So I think the most tangible measure of success is that we end the war in Ukraine, and for a ton of reasons, many of which are beyond the scope of my purview with the federal government. But this war has got to stop, and I think that the price cap will not be successful until we see an end to the war. But we've learned some other really important lessons from this. I think that one thing that's novel about the price cap relative to other sanctions regimes has been this, how targeted the price cap is. So in general, when the United States goes into sanctions endeavors, the idea is to impact the economy of a particular country, and we've seen that in other instances. With the price cap, the goal was more narrow. It was not just to affect the whole. I mean, our sanctions regime on the whole is aimed in a very comprehensive way at Russia, and I think we've been very forward-leaning on that. But the price cap in particular is looking at one industry, and even more specific is looking at the revenues from one industry. And so that's novel from a sanctions perspective. The second thing which is novel has been the global coordination. And this is truly a G7 endeavor. Look, I can fly on United as a premier, they're top tier for the first time in my life because I've gone to Europe so many times. We went to the Balts, had great conversations with the Balts, which are on the front line of this war. We've been to Brussels, numerous times. These are truly our partners, and not just Europe, but across the G7. And even if the price cap did nothing else, I think it showed global unity in pushing back from an economic perspective, and there's value in that. I mean, there's value in unity, and so I think we learned a couple really powerful lessons from this whole thing.
So there is some. So that's forward-looking. Now let's return to 2023. There are still some critics who call into question the success of the program. What would you say in response to those criticisms? What are they getting wrong?
So there are general criticisms and there are specific criticisms. The general criticism comes from, there are basically two different prices for Russian oil. You can get FOB, and that's the price that Russia sells out of a Russian port. And there's CIF, which stands for Customs, Insurance, and Freight. And so that's sort of the delivered price, right? That's what the price when it's received by a refinery in India. And so you have these really broad spreads for the FOB, that's the price that Russia sells it for. And you have much narrower spreads for CIF. And what people are surmising is that basically Russia is assembling a ghost fleet and using that ghost fleet to skirt the price cap. Basically saying, look, we'll sell beneath the price cap, but we'll jack up the price of shipping, and then we'll reroute the shipping profits back to Moscow. That's the general framework from critics, because they're observing that the CIF spread is much narrower than the FOB spread. So the FOB spread right now, Urals are selling, according to Argus, for around $52 a barrel. Brent, I checked right before, was about $80. So you're looking at a spread about $28 for what Russia actually sells their oil for. The CIF spread is about half that. And so the idea is like, look, Russia's just taking that $14 difference and just sending it back to Moscow and using it to skirt your sanctions. That's not quite right for a few reasons. One, we have begged our critics for hard evidence. No one has showed us any. And so when I come here with humility and say, look, things could go sideways in the future, this might not turn out like we planned, we're using lots of caveats to make statements. I also go to big energy conferences and I say to critics, please adopt the same humility. If you're going to make specific claims of evasion, please come with hard evidence. We would love to see it, and we really haven't seen any. But there's actually a good theoretical reason for having a narrower spread on CIF than you see on FOB, and the reason is because for freight and for insurance, it's not the same thing. So FOB, when you look at if you're looking at the Brent price, those tend to have shorter distances. We're talking about global routes that are not traveling all the way around Africa or not traveling for 3 weeks at a time. Because we have had this global reshuffling of oil, Russia now needs to go much further when it's reaching ports, particularly when we're talking about Indian ports. So the freight part of the CIF has elongated. At the same time, we've also made available much fewer ships for Russian products. So you're seeing this premium on ships that are transporting Russian oil. So the freight naturally, because of longer distances and the lesser availability of ships, it makes sense that the freight prices are going up for Russian oil. For insurance, Russia gets charged a war premium of about $5 to $7 a barrel to insure Russian oil. You're going into, essentially a war zone when you're talking about transporting Russian oil. There are good economic and financial reasons why the CIF part of Russian oil costs more than the CIF part of non-Russian oil. And that's just because it costs more to insure Russian oil and it costs more to ship it. So you would expect, theoretically, more, if you had told me, can you guess what the CIF spread is relative to Brent, I would have said, oh, it's much narrower because Russia has to go much further and pay more for shipping and pay more for insurance. So the fact that the CIF spread is less than the Brent spread is not at all evidence that they're using this to evade Western sanctions. It's just evidence of Russia paying more for costs of actually getting their product to a port. Does that make sense?
It does make sense. Okay. We have a question from the audience, and folks, if you all have questions in the room, feel free to raise your hand. Let me read this question. How would you expect a lower price cap to impact the market and current flow dynamics? When can we expect an update on how or if the price cap on crude will be lowered?
So, great question. Europe had committed to a review of the price cap in March. That's informed by the IEA. And Europe had also committed to a sort of theoretical guideline for what the price should be for crude, which is $5 less than the market price of Russian oil. So if the market price is $50, that would suggest about a $2 or $3 discount off of that. Those were European commitments. The United States, in agreeing to the refined product caps, committed to a review in March, along with the rest of the G7, of the crude price cap, but to not commit to an adjustment in the price cap. So we're waiting to see from the IEA to get their assessment. We're doing our own technical assessment, working with the Department of Energy and others. We have always reserved the right to change the price cap if and when it suits our needs. If Russia's earning too much revenue, or if we feel like global markets are not as stable as we'd hoped, we reserve the right to adjust any of these three price caps up or down. But from our perspective, we're going to do a review in March. We're going to take a breath and see how well we think it's working. We're going to listen to the IEA, see what they have to say, and then we'll make an assessment. So, will there be an adjustment? It depends on what we find in the review.
To folks in the room, if you are a professional journalist, please identify yourself before asking a question. And to everyone, please make sure that your question ends in a question mark. Yes, sir.
Thanks very much. Chris Condon from Bloomberg News. Ben, regarding the portion of Russian oil flows that go through the cap and thus are accessing the Western services. Two quick questions. Has anyone from any of the coalition countries gone out and asked for the attestations that the service providers must collect from the companies that engage them? And are they conducting some sort of audit, selective audit on those to confirm that they're not fraudulent? And then a quick second question to ask more broadly. Would you say, given the concerns about getting the cap to be tough on Russia but not too tough, is enforcement viewed as a dial that can be turned in either direction to help make sure that that balance is struck? Thank you.
So, two excellent questions. And let me say, I'm Treasury's chief economist. There are better people to answer enforcement questions than me. But just let me get to Chris's first question on attestation. And let me say from the outset, when we were designing this thing, we wanted to make it easy for industry to comply with. We did not want this to be a big regulatory burden. We did not want to add more to the plates of shippers and insurers and banks and importers. And so initially, we had thought there were various different designs for demanding compliance. And we went to industry and we said, what would be easiest for you to comply with? And they said, well, maybe an attestation model where they can basically say, they either know the price, and if you know the price, maybe you're a bank and you know the price with certainty, that's fine. You know what the price is, it is what it is. But maybe you're an insurer or a shipper and you're not typically informed of the price or the normal course of business. What we asked of them was to find a reliable source to attest to that price. So if you're a shipper and you don't usually care what the price is of your cargo, we're saying now go to a service provider who does know the price, find it out, take a piece of paper, have it written down in a reputable way, and file it away. And so Chris's question about has there been an audit of the attestation reflects the fact that there's not a central repository of these attestations. They're not sent to us. We're not checking each one. We are asking that they keep these records if we need to go back and check for a period of, I believe, 5 years, but I may have that wrong. And so, I think generally the question is, well, what are you doing to check to make sure these attestations are working? So I will say I'm not aware of a broad audit, but that wasn't the initial point. The point was, if we see evidence of wrongdoing, we can then selectively go and check the attestations. That felt like it was the way to do this with the least regulatory burden on industry. I'm using regulatory burden maybe in the wrong way, but with the least burden on industry. Chris, I can't speak for others in the G7 as far as whether or not they're conducting audits. I can say in our conversations with them, they're saying the attestation model is working, both in terms of not placing too large a burden on industry and in terms of being a source of information if it needs to be checked. Beyond that, I can't give you a specific example of when an authority went and actually checked an attestation. Secondly, another good question, is implementation a dial? Clear that if there is intentional and willful evasion of the sanctions, OFAC will take appropriate action. And so that suggests, I think, that we're going to enforce the price cap and that it's really not something that we're taking lightly. We're going to go ahead and enforce these regulations.
Other questions from the audience? Yes. Wait for the microphone, please. Sorry. That way all the online folks can hear you.
Hi, Alice Wells from ExxonMobil. As you said, it is legitimate for countries or companies to access Russian crude oil using non-Western services. And if over time you see the differential that you've talked about start to reduce in a way that defeats your initial policy goal, are you envisioning secondary sanctions?
So you never want to make news from a stage, and the answer,
Sure you do.
The answer is I don't know. We have maintained, I think, the posture with sanctions that will do what's appropriate to continue to place pressure on Russia, but I couldn't possibly announce secondary sanctions at this point.
Are you sure?
Yeah.
Other questions from the audience? So, um, you had mentioned that when the price cap was being developed, something like 90% of the insurance came from the UK, and that has eroded. Um, a large share of the oil was shipped on EU, Norwegian, and British ships. I assume that has also eroded a bit as well. What are some of the efforts that Russia is taking to kind of get around the price cap regime? What has the Treasury Department had to do in order to respond to those developments? Not just alternative insurers, not just alternatively flagged ships, but other things of that nature.
So on your first question, what has Russia done? I mean, Russia is clearly trying to purchase ships and build up a ghost fleet. It has not been that successful. Have they purchased ships? Yes. Have they purchased enough ships to markedly change this whole regime? No. There has been this really massive global shakeup in trading routes, not just destinations, but the flagging of the ships that are carrying various types of oil. I mean, Europe is now sourcing oil from the Middle East much more than it did from before. But so what is Russia doing? I mean, largely, I think that they're trying to build this ghost fleet. They've not been terribly successful at building up an insurance industry because no one believes that Russia is going to pay out. I mean, this is not the most credible story. I mean, would you buy Russian car insurance? I mean, like, I think that they've been unsuccessful in that aspect. They've also tried to blame reductions in exports on the price cap. So you saw that 500,000 barrel reduction in Russian exports, and they tried to attribute that to the price cap. That's really not accurate. What was going on is that Russia's having a hard time placing its barrels. So prior to the invasion, they had about 30 million barrels on the water. That's either sort of effectively storage or being shipped somewhere. Between the invasion and December 5th, when we put in the crude price cap, the number of barrels on the water roughly doubled from about 30 million to about 70 million barrels. And then after we put in the price cap, it's now up to about 100 million barrels. Some of that are the longer shipping routes, so it makes sense that they're on the ships for longer. But some of it, they're just having a hard time placing their oil. Again, this is a bifurcated market now. And so what they're trying to do is sort of blame the G7 for their production challenges and their export challenges, when really their product, is just very different than other types of oil.
Let me ask a question from Derek Brower at the Financial Times. Traders estimate the ghost fleet at about 650 vessels. We've reordered that Russia bought about 40 vessels in February alone. I assume that's a typo. They've reported that Russia bought about 40 vessels in February alone. Is it your contention that this doesn't exist, or that it's much smaller than said, or are you suggesting that Russia isn't buying these vessels?
No, I mean, I did say, just a few minutes ago that Russia is buying these vessels. Hopefully that's clear. The magnitude is unknown. And the ghost fleet is given that name for a reason, which is it's tough to know exactly who's owning some of these ships. Despite our best efforts, we don't have a precise count, and a lot of these are guesses. So Russia is trying to build up a shipping fleet. It's just they produce a lot of oil. It takes a lot of ships to ship 7 million barrels a day, and they're not close to being able to control all of this yet.
So this is another question from Mr. Brower of the Financial Times. Assuming there are some vessels sailing with Russian crude and without access to Western insurance or shipping services, what happens if one of them crashes and spills? Who does the cleanup and who pays?
I mean, that's a great question. I think that it's probably dependent. My guess is it's dependent on the jurisdiction. But, I mean, we have insurance for a reason. I think most ships are using reputable insurance in general. But it just takes one crash to realize, look, there's a real difference from insurance sold out of Moscow versus insurance sold out of London. And there's a value to insurance. So I'm not rooting for a crash by any means, but I will say one thing that is clear is that not all insurance is created equal. And we've known that from a lot of other contexts. But I think it's clear when it comes to shipping as well.
So when Treasury formulated this policy and announced it and implemented it, I thought there was a reasonable chance that Russia would just cut off all exports, kind of as a way to, cause maximal disruption, as a way to blow up the price cap before it had time to really take effect. Why do you think Russia didn't do that?
Great question. So there were 3 states of the world that could have really happened broadly after the price cap was put in place. The first was that the price cap was irrelevant and we went to a 6 sanctions package world where Russia didn't choose to shut in, but Russia had to shut in because it couldn't access Western services. And we had a range of estimates for what that would be, but we thought it would be substantial. And maybe we couldn't reach agreement on the various price caps, or maybe for whatever reason they didn't work. But basically you go back to a 6 sanctions default where you see substantial shut-in. Again, not discretionary shut-in by Russia, but forced shut-in because they couldn't get the ships and the insurance. A second state of the world was that Russia weaponized the trade of oil and shut in not because they had to, but because they wanted to. And they wanted to drive up the price of oil. I think the leverage for doing that has probably passed. Markets were tighter several months ago. If they wanted to influence elections, perhaps they could have done that in October. But that was one state of the world where they weaponized oil the way they weaponized gas. That has not happened at all. And the third state of the world is what we've seen, which is that the price cap has worked and we've seen flows remain relatively steady while revenue has gone down. So the best case scenario happened. We've been clear all along that scenario 2, the weaponization, was certainly a possibility. What we have taken off the table was the status quo, where Russia continues to export at prior levels, but making money hand over fist because it elevated the price of oil. The example I like to give has been they're like a tire shop that just sprinkles nails on the highway and is there at the end to profit from it. They're creating all this chaos and they're benefiting. That's no longer an option. So we've always been clear in saying Russia may intentionally shut in, but that also leaves them with not just depressed revenue today, but if the shut-in was enough, depressed revenue in the future as their wells would dry up, and they've proven themselves to be extremely unreliable trading partner the way they have with natural gas. So we took the best case scenario off the table. We said we don't know which of the other scenarios would materialize, and I think we were fortunate that the best case scenario did materialize. So why did we get to the best case scenario? The simple fact is Russia needs this revenue. It's fighting a war right now. The future prospects of their economy, because they rely on oil, on the oil trade to run, look terrible. Their reputation as a trading partner is on the floor, and they need this money to fight a war. And they've put themselves into a fiscal deficits. They're running down their war chest. And if they chose to weaponize oil, things get worse even faster for them. So there was a lot of sort of, I think, clever thinking, but in the end, Russia just needs this money.
Other questions from the room? Another question that I have is whether or not a link could be drawn between this policy and generating some sort of a fund that could be used to help rebuild Ukraine. And so one idea I know that you and I discussed 13 months ago or so was whether or not a tariff of some kind could be applied to nations that purchase Russian oil, whether the revenue from that tariff could be used in order to create a fund to help with reconstruction following the war. There are other kind of similar ideas in spirit out there. What do you think about those on a going forward basis?
So I think we have our structure now, and I would be surprised if we switched from a price cap to a tariff regime. I mean, a tariff is sort of your classic economics 101 solution, which is you want to create a price differential, but you want to effectively capture the rents. The benefit of a tariff would have been that the rents wouldn't be captured by importers of cheaper oil, but rather by this fund or whoever was assessing the tariff, and that could potentially be used in ways which were strategic. Ultimately, and this is my own view, not speaking for Treasury here, but we didn't go with the tariff because it was just implausible. At the time, we were very worried about rising energy prices. Taxing energy and a tariff is often seen as a tax at a time of energy instability, I think would have been politically unpopular. So, just for sort of political economy reasons, we ended up going with the price cap. And also maybe for implementation reasons, our attestation model was fairly feasible, and we felt like we could certainly, given that we were implementing this over a matter of weeks or just a couple months, feasibility was important, and there were some complications with assessing a tariff. So for I think for both political economy reasons and for feasibility reasons, we went with the price cap.
Another kind of difficult technical question in implementing the policy is actually setting the level of the cap, which of course is related to the marginal cost of production. How did you go about that?
So this is more art than science. I mean, we're asked, well, okay, where's the secret algorithm? Or, are you just going to go marginal cost of production plus 1? Or are you going to, rather than using a dollar amount like 60 or 100 or 45, are you going to go off of a spread relative to Brent, say, which those in the oil trading industry are more familiar with? Ultimately, I mean, this is going to be an unsatisfying answer. We had 2 goals. We felt like we came in at a level that would allow us to achieve both goals. There are wide ranges on the impact, but this is just an example of more art than science. We also had to get enormous number of countries to agree to this. I mean, remember how the price setting goes in the EU, where they have 27 members who all have to vote on this. These members have very different interests. I'm always so impressed with those in the EC that they can get to these unanimous consensus. But ultimately, we got to the numbers we got to because we thought they would allow us to achieve both goals, and we could get consensus across the G7. More art than science.
Last call for questions in the room. Any concluding remarks?
No, I mean, again, just to say, look, there's been a lot of speculation around evasion. And again, please just show us the evidence. We want to see it. But again, just to reiterate, we're coming to this with a lot of humility. And we're just asking that everyone else can adopt the same level of uncertainty. These are really opaque markets. The data is not great on it. And let's just acknowledge that from the outset when we're making conclusions. And thank you so much for having me. I really appreciate being here today.
Thank you for being here. Thank you for your service to our nation during this very difficult time and for the difference this is making in Ukraine's effort to defend itself from such a brutal invasion. Mr. Assistant Secretary, thank you for being here. Thank you all.
Thank you.